Crypto Hotep here with another investing video. We are on week 43 of the Family Portfolio and Dividends Tracker. If you're unfamiliar with the concept, feel free to go to the channel, go to week number 1, where I go through the whole methodology, the thought process behind this. And basically, I gave my family a short list of stocks to choose from, and they made their choices. We then proceeded to use M1 Finance as our broker of choice. With M1 Finance, not only can you create a big portfolio, but you can create like sub portfolios within that big portfolio. So with the family portfolio here, every one of my family members has their own pie or mini portfolio of the stocks that they chose. And then every week we go through this portfolio and look at balances, dividends, market news, anything top of mind, how we're feeling about our stocks as well, and what we're looking at going forward. These videos, for the most part, for my own edification and for my family. Hopefully they'll see these videos when I'm gone and they can be educated about investments or carry it on. If you find these videos helpful, feel free to like, subscribe, comment. Let me know what you think. But by no means are we telling you what to invest in. You need to do your own due diligence, and none of what we say is financial advice. But before we go into week 43, we go to week 42, and we see that we did crack a milestone of $1,700, which is fantastic. At 1709, and then we ended the year at 37.67% year-to-date return. Beautiful. Market gain of $248, dividends earned of $12.46. So let's jump into the first dividends and family portfolio recording of the new year here. So that's why these numbers are a little skewed. You see, we got to build these numbers back up again. But that's also why I don't want to start the week number back at number 1. I want to keep the week numbers going in succession, and just as a better tracker as well. But currently we're at 0.74%, market gain of $12.21. Dividends earned, we did have some dividends at 29 cents. So what happened, right? So again, we had some dividends. Public Storage, Union Pacific, Texas Roadhouse, and Broadcom. Now, if this is your first time watching these videos, you're probably thinking to yourself, Crypto Hotep, those are just pennies. What are you doing? You are correct. Those are pennies. But again, if you saw the first video, our balance was around, I want to say $250, $300. Our balance now is over $1,700 or close to $1,700. And again, I say that to say dividend investing takes time and it takes patience, because you're not going to get those big payouts, especially if you're working with a small account. So the main purpose is to understand, okay, I'm getting a dividend because I'm holding this stock. Let me see if I can build my position up in these stocks and increase this dividend, which is what we're going to do. On January 2nd, we did deposit a little bit of money here. Again, every 2 weeks, we deposit a little bit of money just to showcase kind of you can generate that wealth with stocks, pretty consistently. So what did we buy? We had 2 buys. We had Costco and Apple. And then we also had 4 buys, Kraft, Costco, Apple, and Tesla. Okay. And looking at the portfolio, let's consistently continue to do what we do. Top to bottom, we go to bottom first based on the balances and my wife's stocks. Now, again, the clock started at 0 year to date because we are at the first of the year or near the first of the year. My wife's money weighted rate of return year to date is 2.99%. with a market gain of over 350. Balance is 124.55. Now, again, if you've been following, you know that my wife's Achilles heel on her portfolio was Celsius. We bought Celsius somewhat at the high around March, April, and it subsequently fell and kept falling. I believe that Celsius has developed a bottom around the price of $27 to $30, and it looks pretty good. Now, year to date, you can see how my wife's position with Celsius is currently up almost 10% at 9.33%. Then we have Tesla, Google, and Pepsi. I'm really not going to do anything with Celsius right now because I want to see how they ended the year at and what those financials are. And then as we look at these as we look at these companies here, that's the biggest thing, is not always tweaking your portfolio. Your portfolios really don't need tweaking. If you have invested into very substantial and established companies, your portfolio really doesn't need a lot of movement and a lot of changes. Unless, certain items like the company's missions changed, or leadership has drastically changed, or the financials have just took a nosedive, then yes. But other than that, it's actually pretty boring because you're not really doing anything. And I think that's where a lot of people get messed up, is they always want to tweak something with their portfolio. They always want to change something, and they're not satisfied with boring. With investing and trading, boring is wanted and something you should strive to be. If you always have emotion when you're investing or trading, you're doing something wrong, or you're exposed to a little bit too much leverage or too much risk. So it should be a very boring type of process here. Case in point here with our middle stocks is Amazon, Costco, Starbucks, Target, Nintendo, and Tesla. Very, very substantially established companies. I'm not doing anything with that. Her money weighted rate of return last year was it averaged around 20% or so. So it is at 0.99% currently. Again, year to date, we're at the first of the year, we'll look to get those numbers up. Account balance is $165.88. Now, if we look at our youngest, again, if you've been following, our youngest money weighted rate of return at 2024 was over 60%. Currently, we're at 0.02%. Account balance $188.72, and we still have the same culprits, right? Nintendo, Tesla, Starbucks, Apple. Again, not changing a thing here, not changing anything. And then my stocks, I think I averaged around 15-20%, I believe, in 2024. I'm up about 1%, a little bit over 1%, balance a little bit over 600 at 606.49. with some dividends earned at 29 cents here. Now, with me, again, my positions, I have about 50 stocks that I hold within my portfolio. I wanted it to be 50, and I have it allocated as such. Our growth in those meme stocks are only 5% of the portfolio. Get a little risk in there, but not a whole bunch. In pharmaceuticals, J&J and Pfizer, I'm still going to be buying J&J and Pfizer all day long. Okay. Restaurants and food, there is a company that I am keeping my eye on with this. And again, this is where I brought into that. I'm not tweaking. I'm not looking to change anything, but I'm keeping my eye on this one company, which is Hershey, ticker symbol HSY. The reason is Hershey's financials have looked a little bit abysmal in late 2024. In addition to that, they had a failed acquisition. That perked my ears up. You don't want to hear a failed acquisition in the business realm. That's never good. So I will hold HSY for the year. I want to see what they're doing, what they're going to be doing financially in this year here. Texas Roadhouse is almost bulletproof. Love Texas Roadhouse. Starbucks, Domino's, McDonald's, and then the GOAT of all GOATs, Coca-Cola. Not doing anything with them. Keeping those the same. Finance had Visa, American Express, Moody's, and Aflac. Just a very substantially and established companies here. Industrials, I'll be excited to see with the new administration coming into the White House. I will be excited to see industrials and energy sector, especially Chevron and ExxonMobil. I think they'll be benefiting greatly from the new administration coming in. And then consumers and staples. Consumers and staples is my little engine that could, no matter the state of the economy, the consumers and the staples will do what it does. These are very, very boring companies. These are companies that have been around for decades, and most of them are dividend kings as well. So they are very established. People always need to buy things, no matter if the economy's up or down. They have to buy certain things of needs, and these companies provide those. So I would suggest around a 7 to 10% return on this sector for consumer staples alone. That's what it was in 2024. And then last but not least, my technology sector. I love my technology sector. We have Apple, Coinbase. 2025 is going to be a year of crypto, so Coinbase will benefit from that. Broadcom. I like the Broadcom and Apple team up. Amazon, Google, Microsoft. Again, AI. Meta, and then AMD. I think 2025 will do good to AMD. At least I'm hoping so. Okay. So all in all, a very good portfolio for me. I'm not changing a thing. I was very impressed with my portfolio last year. I didn't get the 100% return as our oldest did, but we did okay. So our oldest does have the crown again as the top account balance. And again, we're still just holding those 4 stocks: Tesla, Apple, McDonald's, Costco. This alone generated over 100% return for the year. So I'm not changing a thing. Again, these are very established companies. We're buying companies that have been around for years, have good track records, and we don't have to do a lot of tweaking. Okay, so with that being said, guys, the family portfolio is currently a little bit under 1,700, 1696.31. Money weighted rate of return, a little bit under 1% at 0.74%. Dividends earned of 29 cents, and then market gain of $12.21. Before we cut out here, I want to bring something to light. If you're having kind of struggles with analyzing stocks and you use Twitter or ChatGPT, one suggestion is to ask the AI to make a step-by-step approach to analyzing stocks and financial statements. This is what I did because I'm a chart guy, right? You know, Crypto Hotep, trader Crypto Hotep. I like charts more so than the financial statements. But when I'm doing investing, I do like to look at the financial statements. So I asked Grok to make me a step-by-step approach using stockanalysis.com, which is what I do use. And they gave me a nice little list here of different metrics to think about, such as looking at current ratio, financial health of companies, debt to equity ratio, what that means and why that's important. So again, using that technology that's already at your fingertips to help you get better. And with that being said, I mean, we can look into Texas Roadhouse, and you know, my fundamental analysis is very easy. It goes looking at revenue, net income. We do look at the balance sheet as well in terms of cash. If there is cash growth, I personally just look at total assets and compare it to their total liabilities, and I ensure that the assets outweigh the liabilities. And then I also look at retained earnings and see if that's increasing as well. And then last but not least, you know, cash flow, net income. I always want to see net income increasing. That's big with me. I want to see net income increasing. I want to see operating cash flow increase as well. That makes me feel a little bit safer about the company. And then last but not least, the dividend, right? All in all, the dividend yield percentage is not the biggest thing. The biggest thing with me is the dividend growth. If that's double digits, I'm good with that. And if the payout ratio is below 65%, which is my threshold, then we're game all day. So with that being said, guys, as always, if you like these videos, feel free to like, subscribe, comment, let me know what you think. But As always, guys, thank you and happy investing.